Okay, cool. So one thing was I was just in Singapore and I attended the Milken Institute event, and Ray Dalio was a keynote speaker. And so I know that you worked at Bridgewater and alongside Ray. And some of the big themes he was talking about were multipolarity, deglobalization, internal disorder, elections, high expectations at all-time highs, and kind of like the limited number of companies constituting much of like the index's performance.
Mhm.
So before I kind of get into some of those themes, do you want to maybe quickly start off and, maybe just like let's go back to, I guess, your Bridgewater days. Tell me a little bit about what was your role at Bridgewater and the big themes that are kind of shaping your portfolio today.
Sure. So, I had spent 18 years in markets before joining Bridgewater. So I joined as a senior person there in their research area. And I had run my own hedge funds, all in relative value trading and dominantly in equity relative value, vol, cap structure arbitrage, risk arbitrage, long short, statistical arb, all that type of stuff within the equity world. But my hedge funds had also introduced me to rates, and I was also now looking at rates vol and equity vol and currency vol and commodities vol. So I had a pretty deep background going in dealer. I was at Salomon for 18 years. So actually, I had done my hedge fund for another five. So I joined Bridgewater with like 23 years of experience. Um, and so I had seen the market making side, I had seen the prop trading side at Solomon, and I had done my own hedge fund. So when I joined, the idea was to see if I could add to their investment process with some of the information I had that they just simply didn't have. And this was 2010. And so um, I joined and created what was called the volatility pillar within their idea generation area. And so I worked with Ray, Greg, and Bob, who were the three CIOs at the time, and two young people, well, a whole bunch of young people, but two young people that are now well known, Karen Karniol-Tambour, who is now the co-CIO, and Bob Elliott, who is now a very well known person on Twitter as well.
Yeah.
Um, and then a whole bunch of young people who were really great at asking questions. And so that experience really sort of exposed me to, I hadn't done macro at all, but I had noticed that whenever traditional alpha strategies blew up, it was always during periods of time in which um, macro was having some sort of crisis. And what that convinced me of is a lot of the alpha generation strategies that exist today, from long short equity to owning illiquid assets and short liquid assets to levered derivatives to owning, I did convertible bonds versus stock. All of those trades, all of those relative value trades exploded at the same time in my prior career and since 2007, 2008 was a good example. Um, and what happens is macro is determines the macro factors and the central bank actions determine to offset those macro factors, determine how tight monetary conditions are, and also how effective and able and willing traditional leverage providers are when to provide leverage to investors who want to take on risk. And when that gets tight, when monetary conditions get tight, either the Fed does a QT or the Fed raises rates abruptly or um, banks, for whatever reason, struggle, all of a sudden financial conditions tighten and beta assets, including a lot of alpha strategies that otherwise seem uncorrelated, all blow up together. And so that was what I joined Bridgewater, it was right after the financial crisis. So I was really focused on what it is that um, dominates all returns. And that seems to me to be the essential mystery of macro and what I learned from Bridgewater. So my role was to step in and consider other information that the firm had not prior used in its investment decisions. And so Bridgewater trades the most liquid assets in the world in a directional way. They don't trade options. Prior to me being there, they hadn't traded options much, and they hardly traded derivatives at all. They basically traded futures and cash securities. And it's still their bread and butter. And so the goal was for me to look at the vol market and see if there were any indicators from the vol market that could help them trading directionally, as well as possibly finding a new asset class for them to trade, meaning volatility as an asset class that would respond to some of their macro indicators that they already had. And so that was the role.
Got it. Do they still have this volatility pillar kind of, at Bridgewater? And what sort of information were you looking at that time?
So I don't know, actually. My connections at Bridgewater are still very good, but we don't talk about business. They are friends, but that's
Yeah.
what they do is very behind closed doors, as is
Okay.
what most hedge funds do. So I can't tell you what they're using, um, but I don't think so. And the reason why I don't think so is those markets tend to be too small for Bridgewater to operate uh, in. Um, and so what I think they continue to do is use some of the things I created and some of the things I'm sure others that have since been there have created that examine the volatility markets, the credit markets, anything with some sort of convexity to it, to better implement their directional views on traditional highly liquid macro assets.
Sure, sure. Now, I think you mentioned this in a podcast before, but were there any big trades or any trades that you wanted to pursue, but maybe Bridgewater didn't want to pursue? What?
I've written about this multiple times. When I joined, 3 days later, the flash crash occurred.
Sure. Great.
And the flash crash occurred for pretty random reasons. But why it was so able to be so devastating so quickly is the market was on edge in a variety of ways, mostly due to what was happening in Europe, where the Greek debt market was savaged in the earlier part of the spring by significantly higher deficit expectations, and so the European debt crisis really kicked off ahead of the flash crash.
Sure.
Then the flash crash hit, and that sort of cemented for lots of investors that a more volatile regime post the GFC was going to be the case for a number of years. And for my entire career, there's been this, and still today, and I think very impactful today, there's been a incredible demand for long-dated equity volatility. And that demand has run over a lot of funds and a lot of people. And this was just one of those. And that demand comes from insurance companies who really can't sell investment management products, but want to because their clients are the same retail that buys money management services for their 401k or has a pension that is managed by their own company or the state. And all of these people have savings that they want to invest, and the insurance company has life insurance policies and term life, which is, you buy a new piece of insurance every year. And the life insurance policy had historically been a pure fixed income security. You got a guaranteed death benefit and your policy accrued value in case you ever wanted to redeem it
Sure.
before you died, um, based on interest rates. And interest rates were very, very low. So insurance companies started, in the mid 90s, started creating um, securities that were essentially guaranteed death benefit. So had a certain floor. You were going to get your $100,000 death benefit whenever you died, but also had upside that was exposed to equities. And they did that by buying an equity portfolio like a mutual fund,
Sure.
adding on to that a receiver, which is an interest rate swap, and a put on that same S&P or mutual fund. And what that creates is a bond plus a call option. When you add it all up, it creates a bond plus a call option on equities with zero downside and so you got your death benefit and possibly an equity performance. And that demand started aggressively and bid up long-term volatility. And I mean, because these are death benefit sort of products, they have 10 years, 20 years in life. And so long-term calls were very well bid. That even affected the dividend market, because if you are a dealer and you sell a long-term call, you are now exposed to dividends. The more dividends you get, the better. So you're long dividends. And so that even impacted the dividend market. But this is about the vol market. Long-term vol got bid up. First, some Swiss banks really provided all the calls to investors. UBS O'Connor, First Boston, all those banks,
Mhm.
some of the French. And in the late 90s, they got overwhelmed by the demand because markets had gotten more volatile, because just like today, there was a significant amount of change in the composition of the index such that it was heavy tech. And so they got run over and they looked to cover their vol at higher levels. And in stepped long-term capital.
Ah,
And long-term capital filled the demand, which was about that, which for them was $100 million of vega. So every 1 point change in implied volatility resulted in $100 million P&L. And they filled that supply with global index vol for 5 years. They sold those puts to the people who were buying them. And we know how that ended up. And so soon after, for years post the long-term capital unwind, long-term volatility stayed extremely well bid while the insurance companies continued to buy.
sure.
And finally, Warren Buffett during the financial crisis said, you know what? I'll sell some puts with the S&P at 700. I'll sell some long-term puts. I'll sell some 5-year, 10-year puts, and sold about $9 billion notional. And that quelled the volatility spike again. It was about $250 million of vega for that 9 billion of notional. And he's like, I'm selling puts. If I buy the stocks at $700, 10 years from now, I've collected all this premium. I like that bet. And he also was not required to post any collateral, which is a fascinating, never would occur again sort of situation. But he's like, it's free money for me. I get to use the $9 billion, invest it, don't have to post any collateral, and I like stocks at $700 10 years from now. And he panicked as did Goldman, as who was also now short from these insurance companies right after the flash crash. And he started unwinding. Now, they were out of the money because the market had rallied significantly since the lows of the GFC, but not very out of the money. And so that demand had no sellers. There was no one who was willing to sell long-term volatility because there was no Warren Buffett. I mean, Warren filled the first long-term filled the market. Well, first the Swiss banks filled the market, they got burned. Then long-term filled the market, they got burned. Then Warren filled the market. He didn't get burned, but he certainly had to pay up for vol. He didn't get burned because he was just short puts without any hedge. But the Vega hurt him. And that summer, 10-year vol was at 38%. You could sell 10-year vol at 38% on the S&P 500. And so I spent many weeks doing crafting that story with the data to prove every piece that I mentioned,
Sure.
assessing the size of the insurance market and what the forward demand of the insurance market was likely to be, assessing all of the possible players who could self-insure that,
Mm-hmm.
and then and then testing whether being short 38 vol is a good trade. And so just the funny thing on that is Bridgewater is the dominant, let's find every bit of long-term data we can find to assess history. They don't want to use any short history. They don't data mine to find the best fits. They just say, look, give it all to me. And so I gave it all to them.
Sure.
I gave them equity markets from the 1780s in the UK, the 1880s, starting in the US, and all the way to, I think the most recent opening market was Russia in 1991, and looked at every country that's ever had a stock market for every country's entire history, and then looked at whether you could lose money being short 38 vol for 10 years. And it turns out you can twice. Three times actually. If you are one of the three countries that declare World War II on the Allies, the volatility is higher than 38. But never before in the US, never before in the UK, and never before anywhere except Germany, Italy, and Japan has there ever been a 38 vol. So I thought, now I have a good sense of every bit that you'd want in a deeply researched way to sell vol at 38. And I met with the guys and they liked the trade and we didn't do it. Realized vol in that period since then was below 20 and implied vol fell 15, call it 12, 13 points in the next year. It would have been the size that Bridgewater would have done it would have easily been $100 million. So, I think we left $1 billion on the table in a year and, 20 billion over 10 years.
Yeah, gotcha. Did that, in terms of, how they made decisions and portfolio made and so on, did that kind of guide how you make portfolios and think about making decisions today?
Yes. So Bob Prince took me aside during the process and was like, we like what you've done, but we need you to think differently. And the way they want you to think at Bridgewater, which I think makes total sense. If you truly want to have a long-term investment process, you want to have something that you can use every single day. You don't want to trade. You want a alpha stream that will last in perpetuity. That's an asset. A trade, it could be a great trade, but once it's over, if you can't repeat it, all the work goes up in smoke.
Got it.
So Bridgewater is in the business, and I think everyone should be in the business of, particularly if you do systematic trading, of finding long-term alpha streams that you can spend all people, the biggest uh, uh, constraint at Bridgewater, and I think everywhere on earth, is time. You have to choose what you spend your time on. And for CIOs who had no experience trading 10-year vol, never trade, hardly trade options, to get up to speed, to be able to be comfortable to place this trade would have consumed more time and possibly hurt their performance in building their long-term alpha generating engine, which already occupied 100% of their time. So that's the thing. What's one's time is worth, and they were very strong, and I think was the right decision, despite the fact that it missed, to take from that um, the idea that what an investment researcher should be looking at is creating long-term alpha, not short-term trades.
Got it. Got it. I kind of want to move back in time, you being at Salomon, being on that Brady commission. What did that early work teach you about kind of the interplay between participants and how this affects liquidity and market outcomes by that token?
Yeah, I mean, 1987 was a tremendous opportunity for me. I happened to luck out and get assigned to the Brady Commission as a 23-year-old, and even more so, I happened to have a very ordinary skill for my generation, but one that was better than all the other people that were assigned to the Brady Commission, who were much more senior to me. I was able to manipulate a spreadsheet. And so I sat with 5 phenomenal and senior investment professionals that Morgan Stanley, Goldman Sachs, Lehman, JP Morgan, and the head of research at Tudor, who had made a fortune during the crash. And I really did the nuts and bolts, what happened in the crash, using the actual trades with the names of their broker and the end client, who sold what and bought what during the stock market crash across multiple markets, including S&P futures, S&P baskets, and rates. And when you see that, and that's I'd been working for a year at Salomon. When you see that, and that's your introduction to markets, for the rest of my life, all I've been focused on, well, not all, a key part of everything I've been focused on is who owns what and what are they doing and why, which is nowadays called flow and positioning.
Sure.
But back then it was, this was gold back then, to know who owned what pressures are they on? Are they in drawdown? Are they doing well? Are they getting inflows? Are they getting outflows? Are they levered? Are they not levered? Each of those factors, and who are they and who are their end investors, has been life work for me.
Okay. That understanding of flow and positioning, is that kind of what guided your decision to not join a firm like Long-Term Capital Management, when I think at a certain time there was a potential that that could have happened, right?
Yeah, sure. Listen, in 1994, when all my friends that were at Salomon Prop went and started Long-Term Capital, I had my worst year of my career in 1995, when all hedge funds and my convertible bond strategy at the time blew up simultaneously because of one of these Fed tightening events. I, I asked for a job multiple times from those guys. Thank God I didn't get it, but multiple times. They were the smartest guys I knew.
Yeah.
So, and Salomon had just gotten over the Treasury bond auction scandal, which at least John Merriweather supervised, um, and was the reason why he had to leave to go to start Long-Term Capital. But Salomon was the worst performing stock in the S&P 500 during the first 10 years of my career, bar none. So
Sure.
it wasn't a great place by the time Long-Term Capital launched. So yeah, I had thought about that very carefully. Not only carefully, I acted on it.
Yeah. So when these,
They didn't want me.
When you're experiencing some of these moves in like let's say 1995, is that kind of at the point where things started clicking for you and you trying to like move away from RV trades more so, or just like thinking about things more in like a macro lens?
And honestly, I had no idea what macro meant or how it worked in 95, and I did not appreciate it at all. By
Okay.
98, it became more transparent with the long-term capital unwind. But that was so focused, and it wasn't just long-term capital. It was government bond arbitrage pursued by many firms, including Citibank at the time, which is where I was then working.
Sure.
But long-term was the poster child, and so you could really focus on that. 95 was a bit more broad, a bit bigger deleveraging. But yeah, by the time I started my hedge fund in 2004, uh, the idea had crossed people's mind that there could be a hedge fund deleveraging that caused a broad contagion, but I hadn't fully appreciated it until 2007 and 8,
Sure.
which I was mostly on the sidelines for.
Sure. Kind of moving into the future. So, I mean, particularly following the pandemic, a lot of this may be the narrative around geopolitical tension, and you had a lot of fiscal stimulation, you had supply and demand imbalances, and what we were doing to kind of like counteract that. As we're kind of moving at the end of 2024 into 2025, what are some of the big themes that you're watching that could potentially affect market outcomes over the next 5, 10 years, right? Based on some of these things that we've just seen in this very short period of time.
So I wish I could have that sort of longer term perspective. So many things could happen. I'm not the type of thinker. Well, I think about it all the time, but I don't act on my thoughts like Ray may.
Okay.
Uh,
So
think
let's say,
about
yeah, let's say like next year, even,
Yeah.
how,
So that's the
yeah,
sort
yeah,
of that's the
yeah,
sort of horizon I like to play on. And well, I think what's clear is that the Fed, and less so other central banks, but the Fed has determined that inflation has died, that inflation is just not going to reaccelerate. And because of that, they can lower interest rates and lower them relatively rapidly, even if the job side of their mandate doesn't come with weakening in jobs that would cause them to need to cut. So one could call that a normalization. And we've been on the path to normalization of rates since mid-December of last year, when the Fed first really focused everyone on this idea of real short-term interest rates being the lever that they care most about. And we had the first anticipation of a significant cutting cycle, which turned out not to occur until now.
sure,
And so that idea that real rates, real short-term rates, are what determine the path of inflation and the strength of the economy is something that the Fed has now fully institutionalized and seems very committed to return to what is a normal interest rate and do it rapidly. Um, and so the question is, are they right? That's what we're wrestling with in markets right now. Are they right that, firstly, that financial conditions are tight, that this particular lever will be the most effective one to ease those conditions, and how that easing of conditions will actually flow through to the economy. Typically, what the Fed does is they don't try to move the economy. They try to offset pressures in the economy. So when inflation is rising, they hike. They hike a lot. They hike late because they have to, get comfortable that the inflation is in fact rising. And they hike and hike and hike until it rolls over. But that's leaning against a trend. Um, when you cut, you should be, in my view, leaning against a trend of a slowing economy that is disinflationary, be below your target, and growth and jobs that are pushing against your mandate. And so we're in this odd position where they clearly don't need to lean against inflation. They certainly don't think they need to lean against inflation. And they think by leaning, they're now risking things going too far. And so they're normalizing. Now the question becomes, what is normal? Is the normalization going to be too far? And so right now that is all wrapped around the pace and destination of rate cuts. And so I think that's all it's about in terms of what you have to look at going forward. However, I think there's a consequential election coming at the end of November, at the beginning of November. And the outcome for the economy, I have some broad thoughts about politics, which is it doesn't really matter much that politicians from both sides of the aisle increase the pie by taking on more debt and deficit spending bilaterally, but in a bipartisan way. No matter who's in charge, they do that. And what differentiates one party, either a full sweep on either side or a split, is who gets the pie. And so from a macro standpoint, I don't care too much who gets the pie. From a single stock sector, and at some level, depends on who gets the spending, does have impact on growth and inflation. But by and large, the who gets the pie is about stocks and within sectors. Is our oil stocks going to do well? Is oil going to do well? One might think that oil would do very well under Harris and very poorly under Trump, but one might think that oil companies are going to do very well under Trump and very poorly under Harris. So, it's a complex thing there, but it's consequential. And so the question that I'm wrestling with post-election will be, is there any sign of austerity from either party? I would expect no. And so that's going to mean continued budget deficits, which are not growing particularly fast anymore. We had this rapid spike in COVID, and now we're back at sort of constant deficits. The change in the deficit is what I think matters, not the change in the expenditures is what matters, not the percentage of GDP. If it stays level, that tends to be a drag on the economy. If it grows, it tends to be a push on the economy. So we'll be looking at how that plays out, and that'll depend on the formation of the House and the Senate relative to the Oval Office.
Got it.
So those are the sort of near-term things, and then then we can speculate about what could happen in the economy, and we don't know whether inflation. Most people consensus is that. And the Fed's belief is that by cutting interest rates down rapidly to about 3%, you'll get a soft landing, which will be economic growth, no unemployment, no meaningful increase in unemployment, with no inflation or target inflation. I just think that's extremely unlikely that we end up there by tweaking this short-term interest rate. That's all that's being done is, the skipper is on the top of the battleship, with pulling this antiquated lever, and hoping that he ends up docking the boat perfectly. I don't think he has that much control. So other factors are going to depend on the economy. The factor I care most about is financial conditions. And financial conditions, which are really the availability of financing for those consumers and companies that drive the economy, the cost of that financing, and the accumulated wealth that allows corporations and individuals to borrow against their wealth and spend, or dissave, sell some of their wealth to consume,
Yeah.
are and then lastly, the conditions of the dominant providers of financial leverage are, which are the major banks, are extraordinarily healthy.
Yeah.
So all of those, and the government continues to spend. So all of those would suggest that um, consumption and investment uh, conditions are very easy. Um, what would change, and the reason they're so easy is income at both the corporate and the individual level is very strong. Job market is not weak; it is strong. Corporate profits are strong. They're expected to be very strong. And so you look at that, the income cycle, and they don't even have to tap this very cheap funding. So there's no need to dissave, there's no need to leverage up, but they can if they want to consume.
Sure.
And so that just is, to me, very bullish for the economy relative to many. And I've been bullish the economy since April of 2020, really never ever suggesting we're going into a recession. And
Okay.
I still don't think we are, which makes me wonder why the Fed is normalizing and expects that somehow that won't encourage consumption and investment, um, and makes me think that the rate, the 3% rate that we're headed toward, is too low.
Sure.
If I'm right, we'll see inflation stay sticky or rise relative to target, not explode. There's no supply shock. There could be, who the hell knows, but that's the Ray stuff. Um, but the demand side and the monetary side is stimulative. So inflation stays up for a bit, but also jobs stay up for a while. Why are we going to see the major corporations start cutting jobs when they're making record earnings and see record GDP? I don't think we're going to see a big weakening in the jobs market, and the government continues to deficit spend. So when you add all those things up, to me, the direction of the central bank to normalize is currently priced in the market as the normal rate is too low.
Got it. Would you say that is kind of this preemptive action or whatever? Would you say that's kind of a mistake almost?
I have no idea. I mean, let's see what he does. He cut 50. Markets are now um, markets are now pricing a 17% chance that the dots they put in place for the next two meetings, which are 225s, actually occur. 83% chance there's either two 50s or a 50 and a 25.
Interesting.
The trough interest rate that they're heading toward is now, call it 287, the lowest it's been except for a brief period of time on August 5th, where people were calling for 75 basis point emergency cuts. So that's, a long way down relative to, and they've told us, whether Waller most recently looks 6 to 8, 10, 12 months, that rates are going to come down, and there's a lot of room for rates to come down. And other Fed speakers are reiterating what was that the dots are just the minimum, essentially, of the path of interest rates. And they're very likely to cut interest rates more. So what's happening? Inflation expectations have risen every day since the Fed meeting. Gold, all-time highs. Bitcoin rallying. Stocks, less so. And long-term bonds are selling off. The only thing that's rallying in the bond market are very short-term bonds.
Sure. The interesting thing about gold, and you can correct me if I'm wrong, but generally that's kind of inversely correlated with rates. But you had a bunch of other factors, maybe like central bank buying and so on, right, that were kind of helping kind of buoy that, right, in recent years. Is that correct?
Yeah, of course. There's been many central banks that have been increasing their gold holdings. The obvious choices from China to Saudi Arabia to I think we saw some net flows that might be more private citizens, but to Switzerland. And there's been a lot of enemies of the US who don't want to hold US assets
Sure.
that are looking for dollar denominated. Now, gold is not technically dollar denominated, but assets like gold. And then, that's been a broad flow,
Yeah.
which, is unpredictable. Price does slow that flow. Like, people don't just buy gold at any price.
Yeah.
It's pretty inelastic. So they do buy gold at most prices, but they don't buy gold at every price.
Okay.
And so I look at gold in my framework. Wait, firstly, I'm a bull on gold all the time. Have always been a bull on gold ever since I left Bridgewater because Bridgewater indoctrinated me, if you would. It's not a cult. Indoctrinated me into understanding the value of non-fiat currencies, and gold is that. I haven't yet bought into Bitcoin yet, but that's because its beta tends to be too correlated to NASDAQ for me to believe it's a monetary equivalent. But one day it might be.
Yeah. The most common what is like the most common saying? Basically it's like a hedge against monetary inflation, right? Is that basically
Yeah,
what?
that's
Yeah.
what. So I don't think gold is a good. So there's three ways you get inflation. You get inflation because people decide they want to spend more. Now that can happen just because whatever they. That's a human nature thing. We are sometimes spend thrift, which I think means you spend a lot, or sometimes we're thrifty.
Sure.
And things change in society to get that, and that creates demand side inflation. Supply side inflation, listen, you have supply shocks. That creates supply side inflation. Short amount of workers creates services inflation and manufacturing inflation. None of those things are hedged with gold because it doesn't have any reason to be. What matters is if there's more gold, there's less gold than there is currency. The
Yeah.
more currency that's created, the less valuable it is relative to gold, and thus it is good for monetary inflation. And so, yeah, I think the real question right now for the gold market, as I said, I always own gold. I probably own it more than most people do. That's a Bridgewater sort of thing. Um, but I'm cautious on gold prices from a short-term standpoint right now because they've really diverted from the three framework things that I look at. Which one is real rates? It is a real currency with a zero coupon, and real rates um, have fallen,
Yeah.
but they have stopped falling. And even still, the drop in real rates has resulted in some appreciation of things like tips, but massive appreciation in gold. So versus real rates, gold seems rich to me. The other part of my framework on gold, two phases is one, are central banks more credible or less credible? And gosh, you can get into a debate about the level of credibility of central bankers. I don't have a dog in that fight. They do what they do.
Sure.
The question is there more confidence in them over the last year or less confidence in them? And again, you can decide, but if you think there's less confidence in the central banks, you own gold. Now, I look at what the central banks have done and say, geez, they solved inflation, or at least that's perceived that they've done that. They should be pretty damn credible.
Sure.
The mission accomplished that's coming from the Fed should be bearish as hell for gold because the expectation, the credibility has improved for central banks. That's not, so to me, that's not a factor right now. But the last thing is monetary inflation. And the US is pretty much done with its experiment in money printing.
Sure.
Sure, we run a deficit, but that's very different than a deficit that's funded with increasing the Fed's balance sheet. So balance sheet's too damn big, but the impulse is over. Over the last 2 days, we've had China news. They seem to be willing to ease credit conditions, lower rates, um, offer margin loans for banks to buy equities, but they're not doing the fiscal yet. If they were to do the fiscal, you could see China being in where the U.S. was in 2011, 2021, and that would be bullish gold. So I'm looking at that as a possible trigger for gold, but I think it's also part of the reason why gold has been being bought by Chinese is there's an expectation that there's going to be that Xi is going to make a meaningful money printing. Um, I don't haven't seen it yet, so I guess we'll see if he does. But if he
Got it.
does, that's going to be bullish gold.
Got
When
it.
I add up all those other things, I think gold's a little rich. So, I'm taking some of my gold long in my beta portfolio off. I put a little speculative trade on in my alpha portfolio short. It's a bull market for gold, but sometimes bull markets correct briefly.
Sure.
I'll
Could
be
you
buying that dip.
Yeah. Could you foresee, markets that are all-time highs? You talk a little bit about kind of like, in inflationary trend kind of being sticky or continuing. Could you foresee a period where, okay, even if markets rise in real terms, they don't really go anywhere or they even go down?
The Goldilocks that could cause, a meaningful outperformance of a broad portfolio of assets relative to cash would be uh, the central bank eases more than is priced currently, and inflation doesn't respond. If that happens, every asset's going to outperform cash. And is it possible? Of course it's possible. It's what has been happening.
Sure.
Assets have done very well relative to cash with, a brief drop in August, but pretty damn well this entire year versus cash. Um, the question is, do trees grow to the sky? There is some value that is gravity to assets. But for now, the central bank is each day telling us they're going to even be more dovish than they were the prior day, with no data to support them changing their increasing their dovishness. So you have to think they have an agenda. I don't think they know anything. They don't know anything more than any of the rest of us, but their reaction function has been clearly to be leaning toward easing relative to and confident that inflation is not going to increase. And if they're right, assets should do okay. Are they going to do great next year? Probably not, but
Interesting.
cash is
Interesting.
getting less interesting as well because now it only yields, less than 4% on a bill, on a 1 year bill.
Sure. I kind of want to go back real quick before we end. Leading into August, we had a bunch of that volatility right in August, but leading into that, we had a little bit of rotation under the hood, some movement into, the small caps and so on. We saw a softening in the Nvidias of the world, right? And so that kind of maybe you could have said that would have foreshadowed, some further weakness in broad market like S&P and so on. But did you ever anticipate seeing the sort of unsettling and volatility that we saw? And did you also anticipate, there being that quick of a recovery and vol going back down to where it was, following that crisis?
I wrote a fairly extensive piece on the dispersion trade and was pretty bearish on that idea and thinking it would unwind. I was certainly aware of the impact of the yen as it was strengthening in terms of deleveraging. And I saw some of the wild moves in July post the CPI report. And so there was clearly some instability. Uh, I, I caught that, but man, the only opportunity at all was to go max long on the bottom on August 5th.
Sure.
And I I covered what I could, bought a little, didn't cover enough, and am surprised that we had as significant a reversal. Looking back, it's clear that markets were already just absolutely convinced that the Fed was going to ease and ease aggressively. And
Sure.
so we're resting on that now.
Sure. Do you get concerned? Because I saw a lot of commentary around how potentially there could have been a doubling down of maybe some of that risky positioning and so on. Do you get concerned, or um, is that kind of foreshadowing something bigger happening in the future, right? In terms of like an unwind or something like that?
I think the big picture here is that the closely monitored, constantly discussed positioning and flow of speculative investors, including hedge funds, is missing the point.
Okay.
Anybody that's in place now is in the position they want. Their risk managers are comfortable with it. They themselves are comfortable with it. They're not over levered. They're in the position they want. There's nobody like delaying a margin call right now. It's
Right.
just what it is. And that happens very quickly. The speculative unwinds happen very quickly. Unless they're systemic and they start feeding on each other. And we just didn't see that. Or they more relevantly, they um, resulted in some banking institution struggling, and we
Sure.
didn't see any of that. There was just no fear in that regard. Um, Nonetheless, the big story is passive. I wouldn't call them passive flows, but investment that is consistent and trending due to strong incomes, strong job markets, strong contributions to 401ks, to insurance plans, and government spending that is resulting, and the deposit and the income from existing investments that is being reinvested that continues to support the trend. And that is, based on what I look at, is quite leveraged, but only a meaningful drawdown will cause that to reverse.
And when you say meaningful drawdown, what does that look like?
10% corrections would probably would mean a dip is less likely. A 5% correction is just getting bought.
Interesting. Okay. Could you ever foresee obviously we have things in place to prevent such a thing from occurring again, like a 1987 crash, but could you ever foresee something like that happening again with maybe an unwind of some of this risky positioning, or like even like these flows, the passive or whatever you were saying just a moment ago? How would that look like?
I would say the odds of a of it's that's conjecture. I think that the odds are low that we'd have a stock market crash. I
Interesting.
think a slower correction would be more likely than a crash.
Okay. That's what I wanted. Okay. In terms of building a portfolio for maybe like next year, 2024, 2025, we had this rapid move down. We've kind of come back up. How do you think about portfolio structuring? You talked a little bit about, gold, positioning in gold and equities and stuff like that. How do you think about portfolio structuring? And do you look at things like volatility itself when you're structuring? Because I know you use a lot of, fixed risk trades, maybe like a debit spread and so on. Do you look at more complex things like skew, and do you adjust certain positions accordingly? How do you approach
Yeah,
that? Especially, yeah,
yeah. I think when you talk about portfolio construction, you first have to start with what you're trying to accomplish. And broadly, for all your viewers, what you should be doing is building a balanced portfolio that's balanced against growth, inflation, and that's it. And not trying to time markets, not trying to pick asset classes, just set it and forget it for the rest of your life and have a 10, 20-year horizon. Now, obviously, some of your money you're going to need sooner, so you have to be more conservative with that. And depending on your age, and your job, like your job prospects, You might take more or less risk. Generally, the better your job prospects are for your life, the more risk you can take. So I would spend time not betting on markets. I would spend time with building a set it and forget it and constantly adding to a beta portfolio of long assets and focus on earning the most money you can in something other than markets. That would be by far my advice.
Interesting.
Now, if
Okay.
you want to speculate on markets, it's really, really hard. You're fighting against, it's a zero-sum game. For you to eat, somebody else has to starve. And that person that's starving is motivated and smart.
Yep.
And you have to beat them. It's fight night. It's not passive. It's not even a casino. It's if you think you're just going to luck into it, there are sharks that are going to kill you. The fees associated with going into a casino are cheap relative to the fees that you pay when you fight against people that are far better. It's like playing poker. It's not like playing blackjack
Sure.
or craps. You are fighting sharks. And so you better have confidence in what you're doing to think you can beat them. I don't. I work every day 24/7. Whenever I'm not sleeping, I'm working to try to maintain any edge I have, and I don't even know if I have it.
Sure.
So how do I build portfolios? Cautiously, with low confidence, attempting to seize on opportunities that are things that are in my wheelhouse instead of being outside of things that I know. And then having some balance and risk management so that if you think you have an edge at a poker table, you don't go all in.
Okay.
You grind. There's that guy. What's that guy's name from that John Turturro played in Rounders? That's the guy I want to be.
Gotcha. Gotcha. To finish it off, in terms of like Damp Spring story, right? What is kind of what do you kind of want to do there, right? You've kind of been running that for a few years and quite a few years. And you started with very small followership. I think, it was like 300 followers or something like that was the number, and then you started scaling that up. So like you've gotten to this point, like what's next?
I have a life I really enjoy. I have
Yeah.
a few hundred institutional relationships, over 15 or so of the big firms that value what I write. So I provide it to them. And then I have, a bunch of people who are professionals who are anonymous to individuals who I've built deep relationships with who want to be members of Damp Spring so that they can ask me questions like you're asking, and I can give data-driven answers to them. And the objective is for me to meet whoever I am, whoever's interested in being a member, on whatever their personal learning curve is, and help them get to the place on the learning curve they want in a way that is very hands-on, very every single day I work with any client who asks me a question, I give them a good answer,
Sure.
or tell them I don't have an answer and I'm not the place. And I find that incredibly rewarding. The financial issue is tiny. It doesn't matter in my life. I only charge people. Well, institutions will pay because they value it, but I only charge individuals because I want to make sure they're serious. I don't want to waste my time with, trolls on the internet.
Sure.
So people seem to care. They want to be in this community and they learn from each other, which is wonderful to see. And so that's how I help in the Damp Spring product. And I'll do it as long as I can add value and people want to hear it. I've also started Two Gray Beards with Nick Giva on Twitter, Nick Giovannik. And that's a different thing. We're offering low touch, 20-minute video once a month, once a week that explains what we think is happening in the world and what it means to a long only portfolio. And the goal of that is most of the people that are interested in being clients of two graybeards don't have much time to think about their investments.
Sure.
But what they end up doing is they end up with a um, in front of their investment advisor, professional money manager, who charges them, 80 basis points a year, for a decently wealthy person, that might be, 40 grand. Um, charges them for their for investment services, and they don't know what the guy is talking about. He goes through his spiel on what's going on in the market. They have no clue. And so we're trying to approach those guys and say the end client with the money and say, listen, here's what's going on. Watch these videos once a week for 20 minutes for a few months, maybe half a year. And I guarantee you will have a better conversation with your financial advisor and and understand your investment portfolio in a way that, if we're successful, your financial advisor doesn't even understand. And
Yeah.
so we think that's just something that, is valuable to society. And, Nick and I love doing it.
All right. Last question. In the last 4 years, what's the biggest lesson you've learned? Could be good or bad.
Yeah, I think the biggest thing I've seen in this, that the biggest mistakes I've made in investing this last few years
Yeah.
has been expecting that momentum would not carry us as far in any direction, down or up. I was bullish all of 2000 and from 2000 and April 2020 to February of 2022. And man, I thought a 5 or 10% correction in 2022 was going to be it. And whoosh, I stayed long too long. Um, and similarly, as markets have bounced, I've stayed short too long. So what's interesting is the momentum. Momentum seems to be a more dominant factor than my models have indicated to me. And it's something I'm addressing, but it's still somewhat mysterious about whether it's driven by money flow into momentum strategies or just more of this passive flow. So I'm
Gotcha.
still learning on it, but that's the thing I'm working on most right now.
Awesome. Awesome. Well, that kind of ties it up for me. I really appreciate your time. Like, this is a serious honor. Is there something else you'd like to add, or I think we kind of hit on.
No, I'm all good.
Yeah.
For me, try to try to recognize beta is the way to go. Beta is not hard. Anyone can advise you to how to do beta,
Yeah.
and try not to focus too much on short-term trading.
Okay. I like this. This is great. Thank you so much. I'll keep you posted on everything, and I'm excited to get this out.
All right,
Seriously.
right now. Pleasure
All right.
meet. See you
Thank
again.
you so much. See you soon. Bye bye.